Well, thanks, Lisa. I really appreciate you having us back. We're looking forward to presenting tonight. We're going to hopefully make this exciting and very interactive. With me tonight, immediately to my right, is Mike Faetta. Mike is a managing director here at Hamilton Capital. He is a senior financial advisor and has extensive experience working with dentists. And farther down is Matt Bartley. Matt runs our retirement plan division and oversees all the kind of the administration, if you will, of that, and does a wonderful job. So with that, we're going to kind of kick it off and talk a little bit about retirement plans. We've got, what are our objectives? Number one is, what's the role, of qualified plans in financial independence? It's big, and we'll talk about that. What are some of the types of retirement plans? What are your fiduciary responsibilities if you happen to be a plan sponsor or trustee? What are some of the what we'll call really key plan design features? And then talk really quite a bit about developing an effective investment choices for your plan and how to handle that. So that's what we're looking to have you walk away with, and we're ready to kind of go from there. So let me start by thinking. I want to cast retirement plans in maybe a light that most people think about it. When people, come to you and they ask you about your retirement plan, it's like, yeah, we either got one or we don't. We got to check the box, and there we are. We don't think that's how you ought to think about. You ought to think about it. I would think about this from both your standpoint and your employee's standpoint as being a wealth building machine. This is probably the best tool you have to build wealth. And, it has a couple of things that I, when you do that, what we try to do and what we would recommend that you look to do as you're thinking about your building that wealth is you're going to put contributions in. We're going to talk about that a little bit. But once they're in there, then once they're in there, we want compounding to occur. You learn compounding at a very very young age. We learned it as compound interest, return, building on return, and exponentially it grew over time. It's the same thing here. You get a tax deduction to put the money away. You get tax deferred growth, and what we're trying to do, or what you want to do, is to unleash the compounding power of the portfolio. And Mike, take a minute and just kind of take them through, some of the things you talk to clients about as far as just the compounding and how to do it early and so on and so forth. Take a second and just kind of introduce that thought.
Yeah, thanks, Matt. Good evening, everyone. Yeah, compounding earlier is better. I think it's probably been hit home for most. But the additional advantage with retirement plans is that you're compounding more money because you're not paying taxes on it up front. That's very attractive with this time of the year. Most of us have just faced, filing tax returns and things of that nature and seeing, okay, how much are we paying to the government versus how much are we paying to ourselves? So to the extent you can get on that, repertoire, doing that, building that muscle of, financial, contributions for yourself early, the compounding is even as you see on, the screen, is that's demonstrative. I mean, it has huge compounding effect on your financial freedom, security, et cetera. So we'd like to see it earlier.
Yeah, and let me add to that. The thing is, if you think about, I'm just going to give you a quick example. If we have $100,000 sitting in a plan, and we make 12% return, then in 6 years, that's it's the rule of 72s. It's going to double, and then it's going to double again. So 1 becomes 2, 2 becomes 4, 4 becomes 8, and 8 becomes, say, $1.6 million. The bigger that return can be is going to help with that. But the earlier you do it is going to be really also key, because if you wait that first 6 years and say, hey, I'm going to go do this or whatever it might be, what you're leaving out is that last potential turn. You go from, that one where I gave the example of going from 800,000 to $1.6 million, because you run out of time. And so, the sooner you can get this in there, the better off you are. And we'll talk about some different ways to get that done. But the earlier, the better. And I know that it's got some very important, I'll call employee retention that goes with it. And we'll talk about that a little bit later. But right now, I want to really emphasize this is one of your best wealth building opportunities. Now, let me go to the next slide and talk about, so we just talked about compounding. And I want to take a minute and talk a little bit about, well, what has to happen for that to occur? So, and so if you think about, we get you the right plan design, you're putting in money. Now that money has to do something. Okay, and we'll talk about getting the right investment choices in there at the right time. That'll come later in our presentation. But three essential things to compounding. And if we, number one, we need to earn a really high quality absolute return. Absolute return is the return you actually make on the money is the return you make. So in other words, it's not how did I do versus the S&P 500. Nobody puts that on your gravestone. I beat it or I didn't. It comes down to if I'm making 8% on my money, and that's just an example, then what's happened is every about 6, 7 years, about 7 years, actually like 8 years, 9 years, I guess it is, I'm going to double, and then I'm going to double again. But there's this little minor problem. If we say we're going to make 8% and we use that and we can do a little bit of projections, you actually have to make it. And so we'll talk about what that means and how that happens. But an absolute return is the return I get on the money. And the two things I might say to you is, number one, negative returns do not compound. They go the wrong way. And the other thing is, if I put it into things, I may have a diversified portfolio, but if I diversify into a lot of losing assets, I'm taking from the compounding power of the portfolio. Second thing is that you'll hear about, well, I can tolerate a lot of volatility. Maybe you can, maybe you can't. But the thing is that the more the volatile the portfolio is, the more often you'll see things go down, and then you're recovering versus just building on return on return on return. So the more consistent that you can make those returns, the better. The larger they are, yes, no question about it. But also consistency is really key. And the last one is you want to avoid capital destruction. And what's that mean? That means we want to avoid big losses, and we want to be aware when they could be imminent. We want to avoid them from this standpoint. I'll give you an example. If we just sat there and did simple financial calculations, and we said, okay, I'm going to put about money away, and then I'm going to make and I'm going to make an absolute 7% return on my money, and you take a 40% hit right off the bat, and then in some markets that's very plausible. Your return to get back on track in 5 years is 18% a year. That's how the math works. It's nothing and getting 18% 5 years in a row just to get back on track is pretty unlikely.
Tall task.
Yeah, it's a huge task. So with that, we're going to take a minute. We'd just like to we'll do a quick poll with you, and then we'll move on to the next topic. Okay, so we're back, and we had a quick question in the chat, which was, could you tell us what retirement plan options are available to business owners? What a timely question, because that's exactly where we're going with our presentation. Let me take a minute though and say this. As we go, if you can type things into the chat, that you've got questions. We'll try to hit them as we go, but if not, there will be some time at the end to interact on some of these things. So with that, let's talk a little bit about the different types of retirement plans you can have. And I'm going to turn that to Matt Bartley. But before he starts to go through this, a couple things I think I'd like to say. Number one is think of this as a vehicle for savings. And you've got different vehicles that allow you to save different amounts on a tax-deductible basis, and you want to find the right one for you. And Matt will talk a little bit about that. And when you get a tax deduction for it, and there's certain limits to what happens, but you also, with that comes the bigger the deductions, the more generous they are in the tax breaks, the more you kind of have to share with your employees as well. And there's some anti-discrimination rules that when you adopt certain plans, and so we'll talk about that a little bit too. So Matt, I'm going to let you, you've been nice and sitting here not saying much, and so give us some brilliance here, will you?
Thank you, Matt.
Yeah.
It's a pleasure to be with you all. So no matter what type of practice you're currently operating or involved with today, there are different types of retirement plans that'll sort of suit different needs for maybe even different stages of where your business is at. So you'll see at the bottom of this deck, and we'll send a presentation out to everyone afterwards that you can refer to. But the two options on the screen now are really designed more for smaller practices, maybe solo practitioners, maybe a couple of employees, but they're simpler plans to administer, okay? And with both of these options, a simple IRA and a simplified employer pension IRA, you could really self-administer both these types of plans. So they have less of a barrier to entry.
Yeah, they don't cost hardly, it's a one-page document usually.
It's very, very simple to get them started. And they're great machines to accumulate wealth for certain businesses that are at a smaller growth-oriented stage. So you've got a couple of different options, and there's the employer contributions only in a SEP-IRA. And a simple IRA, you can have a couple of different options in terms of what your employer contribution is to employees. So with both of these types of plans, there are limited options, and the deferral amounts that you can actually contribute into these plans is a little bit more limited than what you would get with a qualified plan like a 401k.
So give us real quick the top end of that, if you will.
Yeah, simple IRA is going to be about $16,000 that you can contribute on an individual basis. A SEP-IRA.
So that's your salary deferral.
That's your salary deferral. That's
Okay.
right.
And then what would the employer put in that?
You can do a matching contribution of up to 3% of compensation or a non-elective. The employee doesn't have to contribute anything at all, and you, as the employer, need to contribute 2% to every employee in that.
Yeah. So to give you a little more clarity on that, so on that 3%, then what happens is they've got to put in they've got to put in at least 3% of their compensation before you've got to match it, or up to 3. I mean, if they only put in 1, you do 1. Right?
That's right.
Yeah.
100% up to 3.
Okay. Talk me through the difference with that and a SEP-IRA.
SEP-IRA is only employer contributions, okay? And so employee contributions are not permitted at all in this type of plan. The employer must contribute into it, okay? And folks receiving that employer contribution are 100% vested, meaning you can't attach a vesting schedule to those contributions.
And the limit there is like $70,000, and you can put up to 25% of comp if or 20 to 25. There's a couple different ways you do the calculation, which you'll need to get professional help with that. But it's very easy. The big drawback to that is if I'm doing 25 for me, I got to do 25 for everybody else who's eligible, and the eligibility can be there's not a lot of wiggle room, if you will, right? Is that true? And then, so Mike, for a minute, why don't you take a minute and say, where do these fit? In other words, who is this good for?
Yeah. I mean, typically, we're looking at cash flows of the business and what the dynamics are, the size of the business. But starting here is good. We're going to go to some more complex levels of plan design here momentarily, but to get started, a simple IRA or a SEP-IRA really fit the mold of an early practice or a smaller practice where the variables are much less. They're minimized by the number of employees, the number of cash flows that are available to contribute towards employees and owners and the like. So yeah, it's a matchmaking game, with these plan designs that are available, but those two in particular are typically early stage companies,
Yeah,
early to mid stage.
And what I want to emphasize here, I was thinking of, I had a conversation this last week with a client of mine who's now retired. And I was thinking through, he was a great accumulator of assets. He did a fantastic job. And as I said, these are accumulation machines. But what he did is he started, and I go back and I look, he said, I started with a simple. Then he actually started with a SEP because he was kind of a solo practitioner working as an independent contractor. Then he had no employees. Then he started a simple. Then he became a 401k, and ultimately the thing we'll talk about a little bit at the end is, and then he put in a cash balance plan, which allows him to put all kinds of money away.
Yeah, and if I could add, man, that's part of the building journey. Like that's part of building, accumulating wealth is maxing out one stage, and where the plan best fits. And then naturally, as more cash flows are available or more employees come on, you start to unlock the next. And it's really a joy seeing them make those commitments, for the benefits we'll talk about momentarily. But that's a great story too, because that helped him out tremendously and his employees.
And so Matt, go ahead, Matt. I'm going to turn it back over to you to talk about what's next. But go ahead. You got another thought on that?
The last thought on these two is they are simple and easy to get set up and to get started and get you going. And they're easy to transition into other types of plans, predominantly the 401k plan. So that's the slide we'll go to next. So a 401k plan, all 401k plans are profit sharing plans. And they don't necessarily have to be used as profit sharing plans, but that is a powerful vehicle to start to accumulate more wealth in a more charged manner than a simple IRA or a SEP-IRA.
Yeah, and I think with that, if you think about the limits, because the limits are basically the same per employee, and so it's up to $70,000. But the difference between that and a SEP is the SEP is all employer. This you can have your employee be part of that 70,000. They can have money withheld from their check, and so that kind of helps. And so anyway, why don't you take a minute? And there's a lot more rules. Other thing I want to make sure that we're emphasizing here is that this is now the last two plans we're going to talk about, or three plans, are ERISA plans. And the other two are not subject to ERISA, and that creates a whole nother set of rules that we need to go through. Mainly, and we'll talk about some of the duties of that later, but it mainly is you got to act in the best interest of everybody, number one. And number two, there's some regulations relative to make sure that you're performing like a prudent manager, not only an investment on the other side of it too. So Matt, go ahead and talk a little bit. Talk about vesting, some of the things that you can do, and go ahead and things like that.
So 401k plans are more flexible. There are more options, and they're more involved because the government is overseeing it. ERISA, Employee Retirement Income Security Act of 1974. The government is very much paying attention to what's happening in the 401k landscape. And in fact, no matter which side of the aisle you're on, politically speaking, both sides agree that the state of the country in terms of where it's at with saving for retirement needs attention. And so there's a lot of regulation, there's a lot more administration, there's a lot more complexity that starts to enter into your practice's retirement plan when you sponsor a 401k plan. Right. But that shouldn't, we don't want to discourage anyone from moving to that level because there's support. These are very mainstream plans. They're very common, and industry surveys of retirement plan participants indicate that they generally like their 401k plans. Yeah. They're really appreciative of the ability to save for their own retirement, and they need some help. And so with a 401k plan, you as an employer can provide some help to them, as well as acquire a greater benefit for yourself in the way that you structure the plan design for this type of plan. So the plan design, just like you wouldn't go and set out to build a house without a plan, the plan design is really taking into account what it is that you want to build, how you want to go about doing it, what your employees need, what you need as a business owner, and go from there. So some of the options with these plans, you can set up a matching scenario, just like in a simple IRA. You can ultimately encourage your employees to save more, and they'll receive an employer matching benefit. You can structure that in a way that you avoid some of the testing that ERISA is going to bring into your life if you sponsor one of these plans.
Yeah, so let me jump into that for a minute. So the testing is really, think about it as, first of all, let's talk about the limits. The limits are these. You have 70,000, but the employee can put up to 100% of his compensation, up to $23,500. And if they're over 50, they can put an additional catch up of 7,500. So before the employer even puts in a dime, you can save, and this means for you as an employee too, potentially $30,000. Now, where we get limited is if this all is just you and your employees aren't participating, then that limits what you can put in as well. That's what they call this anti-discrimination testing. So what Matt was referring to was to say, and you can do safe harbor things to allow you to put that $30,000 away. It was kind of like, like, for example, in the simple plan where they said, you could, if you match, we'll match up to 3%. Well, one of the things you can do here is you can match up to 4%, okay? Or you could just give everybody 3%. We'll have an opinion on what you ought to do and why, a little bit later in the presentation. The other thing is that, what's the vesting on this, Matt? What for your employer contributions or for that safe harbor contribution? How does that vest, and then how does everything else that you might put in vest?
Yeah, that's a great point. So with a safe harbor match, employees receiving that are 100% vested in that money right away. The additional layer, and think about this, if anyone remembers Led Zeppelin, Robert Plant's Stairway to Heaven, what you start out with is the first step is just your basic 401k. All right, individual contribution limit this year, 23,500. Second step on the stairway to wealth accumulation is that match, that safe harbor match, okay? And both of those are 100% vested for those employees from day one. The third leg of this, the third step, is the profit sharing. And this is where you can get a little bit creative in terms of, okay, I want to attach a vesting schedule to this. This is pretty serious money, pretty serious benefit we're providing to our employees here in this environment. And so the government gives you the ability to sort of protect yourself a little bit and require them to stay before that money belongs to them 100%. And so again, more flexibility with this type of plan. You have some options in terms of how long you want to do that. I will say, just anecdotally from what we're hearing from clients, is the trend line is really moving the vesting schedule earlier. Okay, so you can go all the way out to 6 years. The trend line is allowing employees to have a greater ownership in a less time. More like 3 years is a little bit more common.
I want to add on to that, though. This can be a great retention tool, because if they've put a bunch of money and you've put it in for them and they walk away 3 years or 3 years early, you could have potentially kept them another 3 years because they just want to get the money. And so you want to think about it not only from what do the employee want, but how does this fit? How does this become a retention tool, for us? And so that's a really an important part of this. At the end of the day, it's about designing the plan to work for what you're trying to get accomplished. And the two things I would really emphasize a little bit is this idea of building wealth for you, building wealth for your employees, and also at the same time making sure that you can use that to help retain employees. If you've got a healthy match, or if you've got a healthy contribution, it's more likely that they'll stay. But let's say they don't, okay, for a minute. Let's say they don't stay. Let's say that they're 50% vested. What happens to the other 50%, Matt?
Well, those assets revert back to the plan. They become an asset of the plan. And in future years, it could be used to pay permissible plan expenses, such as funding your profit sharing contribution for the next year.
Yeah.
Yeah, playing it out too with, clients when we design the plans. I think the fear of the unknown is often a hurdle with retirement plans. For an employee, the fear of the unknown is like, can I commit to, contributing 3 or 6 or more % of my earnings? I may need those funds, but the known is that retirement will happen someday. To Matt's point about compounding and starting early, you really want to stay committed and flex that muscle and overcome that and get free employer or, employer match dollars that you're otherwise leaving on the table. And then the fear of the unknown for the employer or the business owner is like, can I make these commitments? Can I, make those contributions for the employers? Do they value those? What's the benefit to them? Some may value the cash, but the encouragement is like, this is here for your benefit, and I care about your success in our business, but outside when you're gone too, and hope you retire with us.
Right. And if you've got those kind of employees, one of the things you're going to want to say to them is, hey, I'm interested in building a career for you, not only, with what your role is inside the practice, but also that I want to make sure you retire well. I want to build a meaningful retirement, for you. And part of that is, and we'll talk about how to get investment results in a minute, but really the key issue is to start is I got to put it in there. And it'll have a lot of benefit, a lot of cultural benefits to that too.
So last comment I would make on this screen, I don't know that we covered, is that on the profit sharing, that's discretionary. So there's flexibility built in. If the business is doing really well, then everyone benefits with what elements put towards profit sharing. And if there's a tough patch, it's not a required contribution annually. So you have that flexibility.
Yeah. And I would say you don't have to make necessarily a profit to be able to put it in. It's really based on your salaries. You could actually create a loss. Not that you're going to want to do that, but the point is that there's a lot. The key is to get a great advisor who can really sit down with you and say, here's the kind of plan that makes sense for you, and this is where you are in life, et cetera. And so let's go back, Matt, to the one for the guys that got gray hair like me. And talk a little bit about that.
Yeah, so this is sort of the fourth step. You start with a 401k, and then you add in safe harbor matching contributions or safe harbor non-elective, and then you layer in that discretionary profit sharing. This is the fourth. This is supercharged tax deferral that is honestly somewhat mind-blowing that the government allows individuals to be able to defer the sums of money that are allowable in cash balance plans. We love these plans. And if you think about, an abstract, career cycle of a dentist, graduating, possibly student loan debts, joining a practice, potentially then buying a practice, paying down debt, and all of a sudden, you're sort of looking at a much shorter runway than when you started out, and you think to yourself, boy, I really want to catch up. Well, this is a vehicle for you to be able to do that. So a cash balance plan, it's very complex, okay? We're going to try and simplify it here quickly for you, but they are complex, and oftentimes clients don't understand exactly how they work right away. It takes a couple of years. Sometimes when you sit down and really start to evaluate it and you learn more, it's kind of like, building IKEA furniture or something like that. You really want to pay attention, because you don't want to get to step 3 or 4 down the road and realize, oh my gosh, we've taken some bad advice. It's really important to get good professional help. There's actuarial professionals that you'll need to assist you in running this plan and designing this plan and making it efficient. But in terms of dollars that you can actually defer, it's really incredible. One thing I will say, just
let me add to that.
Please do.
Yeah. So what you're funding, let me explain what this is. This is like your grandfather's pension plan. This is what, it was working at a company. They basically said, you're with us for life. we're not only going to, you're going to go ahead and we're going to put money in a way for you. This is an employer funded plan. But the second part of it is, and then we're going to give you a pension, an income for the rest of your life, or you and your spouse's life. And there was different things that you could do there. This is basically that same thing. In other words, but there is a little caveat to it. You can eventually take a lump sum balance out of it. And the amount that you can fund for is an income of $285,000 a year. Which is huge. And what that means is, if you think about it, if I'm starting with nothing in this plan, and all of a sudden I need to get to an income of $285,000, okay, a year, that's a lot of money, and I got to get it in there fast. And so that's what creates these deductions that can be, instead of like $70,000, it could be $300,000. And you don't have to go at 285. You can say, I want to create a benefit of 100, or I want to, whatever. But this is a way to pump a lot of money away. And what happens is, and this is the other part I'll add to it, ages and wages matter. What does that mean? That means that if I'm older, the money I have to put in for somebody that's older is completely different than what I have to put in for the 30-year-old. Because if I'm funding a similar benefit for a 30-year-old, I've got from 30 to, say, the retirement age is 70, then I've got from 30 to 70 to put that money away and give him that benefit. For me, and let's say I've got 5 years left, I got to get it in there. So it mainly goes to me, and there's some rules around it, but this is, we kind of call this the owner's plan. This is the plan that for the dental owner who's got a lot of excess cash flow, wants to fund it and shelter it. This is the place, and that generally happens when you're in your 50s. Oftentimes you've gotten through all the debt stuff. You maybe got your kids raised, you may pay some college, whatever. And now it's like, I got to get at it, and I got to get it hard. This is probably the plan that needs to be looked at. And you study that. So with that, I think, are we at a poll question? All right. Well, let's get the poll question out, and then we'll move on. Great. Well, thank you so much. We got a couple questions. One was financial education, and the other was how do we teach them how to invest money? And so we'll kind of hit both of those a little bit. Matt, talk just very briefly about financial education. What I wanted you to talk about is the tools that are really available, maybe bring in technology, what's there today that has not been there before, and also how do you is having an advisor who understands this stuff, and can help the employee through it a little bit.
Yeah, great. It's a very important topic and very, very pertinent. And, retirement plans are viewed a little bit differently today than they were maybe 10 or 15 years ago, where it was sort of like health insurance, and it's really important that you have it and how much it costs. And there's sort of this convergence around retirement benefits in the workplace and technology. And that's all sort of coming together and giving people access not only to education, but also tools to help them understand where they're at, what the savings gap they may have, if any, steps they can take to address those gaps. And so with a 401k plan, oftentimes it'll come with a collection of tools and resources, calculators, and making assumptions for people that they can then adjust and fine tune based on their household situation.
Okay, great. I'm going to take a second, and we've got on your screen now things that we think are essential to the plan design. And they're designed with a couple things in mind. They're really designed with the idea of building financial independence for you and your people. But then the other part of that is to also have great employee retention with this. Okay. And I'm just going to run through them real quick. So the match is simply, hey, I'm going to match your contribution. Auto enrollment is good in that you're saying, I'm going to automatically enroll you unless you tell me you are not going to go in. You opt out. And a lot of people will just not opt out. And then they start on that process. Matt's already, talked a little bit about the profit sharing plan contribution. Great investing allows them that 2 to 6 years, you stay a little longer. And the last one, which was somebody asked about, is professional investment management. If I can talk about one thing, let's move on to the next slide. And we talked about this earlier, so I'm gonna switch because I want to keep on moving to the investment side. Before I do that, there are protections that you can address. One of those is that if you are, and these mainly have to do around investment management. I will say this: when you get pitched for a retirement plan, they seem to always talk about how I can prevent your fiduciary liability, and these are all tools to do it. And and you can read them there. You'll have a copy of this. We're happy to answer any questions about this later. But what I'm saying is, to me, this is table stakes. This is not something like, okay, well, hi, I'm going to help you run this plan. And all I'm going to really do is just tell you how to protect yourself from liability. Last time I checked, we're trying to create a wealth building machine. And the last time I checked, the idea was to build meaningful retirements, which means you actually have to get the money in there. And once it's in there, it's got to do something. Okay. And I think that's the thing I would really emphasize to you more than anything. So with that, let's talk about investing. Okay, real quick. So, it's a marathon. It's not a sprint. Okay. It's about compounding returns over time, which means I need to build three things into my returns: absolute return, absolute return, consistency of return. Don't get derailed. Don't have my capital destroyed. And there's got to be, and that has to be managed to that. Those are management objectives. Those are not wishes. Those are management objectives, if you're going to get help with this, you want a manager that can do that, that can help you with that. Next slide. This is the thing that is probably the biggest Achilles heel in most qualified retirement plans. What they do is asset allocate. Mike, you talk about asset allocation and its importance. I'm not letting you talk enough.
Oh, no, that's fair. That's fair. You've done such a great job. But yeah, really asset allocation, fundamentally, there's the reality is that we can't choose the conditions that we invest in as investors, but we can choose how to invest in those conditions. And when you're talking about the complexities of how do I choose stocks, bonds, cash, real estate, the whole plethora of options that are out there as an investor, it's taxing. It's intimidating. Often people look backwards. Okay, how did these funds do? And I'll select those. Those were the best and hope they perform okay. Or the adage that if you hold it long enough, it'll all work out and own a little bit of everything. And in some environments that can be true. In other environments, that's not the case. We've seen all of those environments. They happen to be fairly cyclical in nature. And so being an expert in your craft in dentistry, which is very challenging, and you work 7 to 7 or more hours in some days, to go home and be an investment expertise or professional at night, it's a lot to ask. So I think partnering in your journey with others that are guiding you through that process is paramount.
Yeah.
And yeah, I'll leave it at that.
And when you think about what happens, and typically what happens is that, and I'll just stay on this slide. And what typically happens is that you sit there and you provide a menu of investment options, and what it really typically looks like is taking most of the major asset classes that are sitting on that wheel, or some of them, and we're going to give you a mutual fund choice for that. Okay, and you need to, then you say to the employee, pick. Okay, and they're scared to death of that decision. They don't know what to do with it, et cetera. In fact, most of our dental clients don't know what to do with it, to be honest with you. And so one of the key things that you have to decide is, what am I going to do about that? And I'm going to say this to you: no amount of education is going to ever be enough. And so I think that the idea of getting professional management, as opposed to letting your employees make the decision, have professional management get it done. I can't emphasize that enough. So go to the next slide here for a minute. So here's typically what happens. On the right-hand side, here's what typically they do. They come in, they give you this menu of funds. They say to the employee, you make the decision. By the way, it don't matter. It doesn't matter. Those decisions are going to impact your future performance. It's going to impact your future accumulation, but good luck. Okay. And then what happens is they administer it because the advisor is going to say, well, I don't think that large cap value fund is performing as well as another large cap value fund. So we're going to switch it out. That's all they're going to do. Well, somebody has to decide whether it's need to be in the large cap value fund to begin with. And that's your employer and our employee, and they can't do it. So one of the other options is to say, let's take this, and especially in environments like we're in right now, let's give that to somebody else. You can hire this manager. And furthermore, I skipped over it. You can hire it so that you lose all liability in this thing. That it's basically that there's managers that will take the liability away from you. And it's called 338, Section 338 ERISA. And they can do one of it two ways. It's not one, they can actually manage it, or B, they can manage your selections. You really, if I'm going to suggest to you, what do you want? You want the manager. You want the one who's going to make those calls for your employees. Next page. Now, you can give them choice. You don't have to have them all do the same thing. So you could create just like you can create a plethora of mutual funds to be in, you can create a choice of managed accounts that they can go into with different investment objectives, et cetera. So you can do that as well. And so and if we could say one thing, I would recommend that you look at this and find somebody who can finally be dynamic. Mike said a very important thing, which was, I can't choose the investment environment that I'm in. In one environment, certain assets will do well. In another environment, other assets will do well. That means we have to be dynamic. We need to be looking at it all the time. What happens is when employees do that and they try to be dynamic, you know what happens? They're always late and they're always chasing returns. It's too little, too late. And what happens is their returns show it. The other thing that happens is that what do they get advised to do? Set this long-term asset allocation, buy it, hold it, leave it in all environments, and hope it works out. And it's based generally on this idea that, what happened in the past will be repeated in the future. All you got to do is wait long enough. And wait long enough could be, and I kind of say, what century sometimes. But that's what they're set up to do. And the reason they do it, the advisors do it, it's easy. It's easy. It's not that hard. Managing assets, calling these asset allocations takes skill, and it takes a certain team. So with that, let's go to the next slide. So let me real quick just talk about cash balance plans just for a second, because we're over a little bit. A cash balance plan has a different investment objective. Remember, I said that we're funding for a benefit. But you have to. This is what Matt said was the over under. If I'm under, I don't hit that number, I got to make it up. I got to make a contribution. It's a guarantee. Okay, and it could be a big one. If I hit over the number, the federal government says, "Oh, you accumulated too much." So by the way, there's a talk of taking the money out and paying tax on it. There's a 50% excise tax on that as well. So you lose it. So you kind of got to thread the needle, and you've got to have, and if there's one place that if you're going to have professional management, it's right here. You've got to hit this one, correctly and go from there. So with
The only comment I would add there, Matt,
Yeah.
is consistency matters. In that
Oh,
plan.
yes.
You have a policy that you're sticking to, and you're watching that very carefully.
Yeah. My comment on cash balance plans, managing the volatility is really important
Huge.
because it's easy to fall off both sides of the horse, and you don't want to wing it when it comes to investment management for your cash balance plan.
Yeah.
And I wouldn't minimize the importance of not just the cash balance, but Matt mentioned this earlier, like consistency in a 401k, or
Yes,
a simple
exactly.
IRA, or a SEP-IRA. I think we share oftentimes, like, if you have a great plan design and you put the money in and it doesn't perform, then it's not maximizing its real benefit.
Right.
So in some environments, like the last 5, 10, 15 years, depending on what your time horizon has been as an investor, most are like, this has been pretty easy. I put the money in, I keep getting my statements, it's going up, right? For those that maybe are on tonight that, invested as, 2000 to 2012, not so easy. The conditions we were talking about and plan design and some of the, challenges that people faced in those years were difficult. So it goes back to, it's very
Yeah.
important. select the right plan, make the contribution that your cash flows can support as a participant or a business owner, trying to maximize and getting that compounding on the return.
Yeah.
Is critical. And it's generally anywhere between 50 to 80% of one's, wealth that they accumulate as they near retirement.
Yeah.
This is a huge piece of the pie because of all the benefits that these plans offer.
Right.